Well, it's a very good morning from him, and of course it's a very good morning from me. Welcome to our summer. That's just a bit of tongue-in-cheek there, isn't it? But this week it's really heatwave territory out there. I've got to go to London this week on business, so I'm going to boil on the tube and all those good things. So I hope you're well. Hope it's good. Welcome to my live stream. If you're watching us on video or you're listening to the podcast, whatever is your cup of tea, I'm happy to update you on a few things. Today I want to take a look at two topics. I want to take a look at repossession proceedings, just because we need to be aware of that, starting to get that kind of way, maybe, I don't know. But also I want to pick up on capital gains tax for the current tax year, just to sort of summarize some of the key figures for you as well. But before we go there, a couple of things like really just tickled me in the last couple of days. The first one was the story from Canada. I don't know if you heard it, about these guys who were transporting 5 million bees across Canada, because bees, as you know, are used to pollinate, and bees aren't as widespread as they used to be, so farmers are buying them in. And there was a story, and I'll show you the photograph because it's really quite a funny story, of these beekeepers who were called out to rescue 5 million bees which fell off a truck in Canada. And there's some photographs, if you can see the live stream here, of these beekeepers, all their gear. Apparently everyone got stung. I mean, 5 million bees. Look at those photographs of that lady there who's getting stung to death as well. And there's this chap looking very tough, because he's like a beekeeper, he knows how to look after bees. It does make me laugh, that one. So that was a great story, wasn't it? And the other story I was listening to this morning, actually, and yesterday, and that's about this stage with the recession coming in. A lot of people are struggling business-wise, but there's still a lot of people on social media who are living the dream, living the life, winning at the life, And I was listening to a couple of people at the Lido this morning, the change room, saying to everybody who was prepared to listen to them how great their life is, and retired and off to Portugal, and I do this fitness, this things. I think people that shout out the fact how successful they are probably aren't as successful as you think they are. I think it's down to your self-esteem, isn't it? If you're successful in yourself and your business and your life, whatever it is, your definition of success, if you don't go around shouting it, I think you really are successful. But if you have to find an audience to shout about it, then I'm not entirely sure if you're successful. And if I had £1 for every person on LinkedIn that was telling us how successful they are, look at me, it's just absolutely ridiculous. So that was the second point for you. But that's just my own personal view. I hope you like that one. Okay, let's get on to the most important topics today then. Let's get on to our topic that is going to just educate you, really update you on CMAP, the syllabus, and all the things that you need to be aware of as a mortgage advisor. So let's head over to our whiteboard for you. Here we go. Now, the topic I want to look at this morning is repossession proceedings. This, of course, is the back end of the textbook. This looks at repossession. As a mortgage advisor, mortgage broker, you'll probably never get involved in this neck of the woods. And I think that's a good thing, because it's not particularly nice. But you're seeing more and more of it coming through in the next sort of 3, 6, 12 months, as people struggling with their mortgage, whatever reason, they can't pay it, they don't pay it, and they have to get repossessed. Now, I want to go back in time a little bit for you, because I want to go back to 1986. 1986. There we go. In Stoke Newington in London, where I was working as an assistant manager of a building society, the Leeds Permanent Building Society, not to be confused with the Leeds Building Society, which used to be called Leeds and Holbeck, but there we go. And I was assistant manager. Now, we had an arrears department, of course, at head office in Leeds, who dealt with arrears and repossessions. And I had a phone call from arrears department asking if one person from the branch could represent Leeds Permanent at a forthcoming repossession. And if I remember rightly, it was at something like 22 Bethune Road or something in Stoke Newington. Now, I was only young. My manager was off somewhere, probably gallivanting with solicitors and accountants on expenses. So I decided to go down there and see what was going on. And I was horrified by the whole thing. Now, my arrears department at head office had gone through the right process. Let's talk about what the process they went through. Now, as you can appreciate, with arrears and repossessions, you have to do so much more now. So the first stage, which my arrears department would have done, is the pre-action protocol. Now, we call it that now. They never used to call it that back then. But this is, we covered that in previous videos, but this is where you do what you possibly can to help the person get out of their arrears and their problems and their issues or whatever it is. You help them, you bend over backwards to help them as much as you possibly can. Now, if you've done that, And the Leeds Permanent were very good at that sort of thing. But of course, if that didn't work, the first thing they wanted to do then is to petition the county court for a possession order. So that's stage number 2. They petitioned the county court, county court, for a possession order. Now we call it repossession. Don't know why, actually, because the lender has never actually gained possession, so it can't be repossession, can it? But they had to get a possession order from the county court. In Scotland, it's the Sheriff Court, which I think is a much better name. The Sheriff Court sounds great, doesn't it? But that's what the Leeds Permanent Building Society had done. And the court process had gone on. I wasn't involved in that, of course. And the Leeds Permanent would have had a lawyer who would have gone along, or barrister would have gone along to the county court and represented them, and they would have gone through the motions. Now, the court would have made a decision about the case. And this is really important because all these things cost money. Courts cost money, the fees, the lawyer fees, and all this money, by the way, gets added to the mortgage debt. People don't appreciate that. And of course, it gets higher and higher and higher. So you've really got to have one chance really of going to the court to get your possession order, because you need that order to gain possession. You can't just walk in. Now, the court comes out with 3 decisions. So let's take a look at the 3 decisions that the court's going to come out with. Now, the first thing that the court might come out with is they might just just chuck it out. I love that, don't you? They might they might adjourn it. Here you go. In other words, they adjourn the whole thing to a later date. They might say, "Look, Leeds Permanent, you've not done what you should do. To go off and do it and come back when you've done that." In other words, if the pre-action protocol hasn't been followed, or if there's no help or assistance, or follow the process at MCOP 13, then they'll chuck it out. And of course, that costs a huge amount of money. And arguably, that's the Leeds' fault, not the borrower's fault. So that's the first decision they can make, which actually is pretty much unusual as well. They could, and this is number 2, they could suspend possession. There you go. Now, this is where the courts feel that in their decision, in their insights, the magistrate, they should go back, the Leeds should go back and do this, do that, or do A, B, or C. And when they've done that, great. If that fails and the borrower doesn't adhere to those conditions, then they'll get a possession order. So, for example, it could be, what we want to do is go back and we want the borrower to be paying £200 a month, plus the mortgage payment, of course, plus £200 a month over the next 2 years to clear the arrears. And if they do that, it's great. So that's the order. That's what the court have said. And if they fail to do that, then you can get your possession order. That's how it goes on. That's called a suspended possession, like a suspended sentence, isn't it? But the big one, of course, that they're looking for is outright possession. Outright possession. There we go. Outright possession, and in which gives the building society, or the lender, of course, 28 days in order to gain possession. So that's the document that they're looking for. That's the first part of the whole thing. So what happens then? Well, the next thing is that with this piece of paper, the Leeds Permanent had the authority to go and gain possession of the property. And that's why I was called in. That's when I got my call. What is it? I was about 23 at the time, I think, so I had no idea what was going on. So I rocked up outside this house in Bethune Road. I hid behind the hedge because there was lots of people there who looked much bigger and tougher and stronger than I was, because the Leeds Permanent had to gain possession. But you don't just go on, knock on the door. You have to get bailiffs involved. So we recruited a firm of bailiffs who are big, tough guys. They were too. And their job was to go in and gain possession. That was it. So they knocked on the door, and they were obviously very good. And the lady we'd actually contacted the local authority at the time to come around and help out and give us some accommodation. So we had all that sorted at that point. So once the bailiffs had gone in, we got the keys, we got it all sorted. We started to change the locks. Locksmiths did all that as well. So next sort of steps really are to vacate the premises. There you go. Vacate the premises. Locks changed, turn off the lecky, turn off the water, make sure everything's all in order, really. If there was anything in the property and there wasn't any sort of furniture, then we're supposed to sell that and put the cost of that on top of the mortgage account, because that goes back to the borrower as well, any sort of fittings in the property. Obviously, you hear some horror stories of people wrenching out the central heating and stuff like that, the parquet flooring, all sorts of things, don't you? Interestingly enough, back in the 90s, we never really bothered with this because a lot of people just hand in their keys. You might have read about that, people handing in their keys in the early 90s when property prices went that way, downwards. And of course, people just couldn't afford their mortgage because interest rates went right up. So on a regular Saturday morning, people just handed in their keys to the lenders. It was a common occurrence. And that, as you can appreciate, means they don't have to go through any pre-action protocol or petition the county court. They literally got the key to the premises. Now, once the building society, now the mortgagee in possession, as it's called, or the bank, of course, has possession of the property, they've got to get that property, that security, sold. So that's the next step then. They've got to sell the property. And their ruling here under MCOB 13 is they've got to sell the property for the best possible price at the quickest possible time, which is often difficult to do in a difficult market like now, for example. Putting a house on the market now wouldn't be the best time, but you have to put it on the market. You have to sell it at the best possible price. Makes sense. Auctions are often used. Estate agents will often be used as well. And if there's an offer, they then have to put a notice out online to say if anybody has got a better offer in 7 days, please come forward. So they have to prove they've got the best price in the marketplace at the time, which is why auctions are very, very popular ways of selling properties. Of course, once the property has been sold, and the money has been made, completion has occurred, then that, of course, goes and gets onto the mortgage account, pays off the mortgage debt. And in this country, if there's any money left over from that, if the property price sold for a good price and then they paid off the mortgage, it goes back to the borrower because we don't foreclose in this country. I'll go on to that in a second for you. The last part, and just to quickly mention this one, number 5, is known as the equity of redemption. Here we go. Equity of redemption. Now, the equity of redemption is a law which is given to all borrowers that they have at any time, right up to completion of the sale of the property, they've got the ability to pay off the mortgage. Not to make monthly payments again, but to pay off the mortgage. That is this law, to be able to redeem the mortgage at any time they want to. And if they did, that's great. I had a story once of a couple who were repossessed. It all went through to sale, etc., but hadn't completed the property, and they rocked up with a bag of cash to pay off the mortgage at one branch. They paid off the whole thing. Where they got the cash from, I've no idea. But that's the equity of redemption. It's worth just mentioning that as well. Now, that's pretty much what happens, really. Now, if there is a large surplus, as I mentioned to you, from selling the house, then they'll pay off the mortgage and all the costs, all the arrears. If there's money left over, that goes back to the borrower, and that makes sense, doesn't it, if you think about it? But in most cases, the mortgage account would have kept going up with arrears and costs, etc., and maybe the price of the property would come down because it's been sold forcefully as a repo. So in most cases, there'll be a shortfall. Now, shortfalls can illegally be obtained by the lender back to the borrower. They can go back to the borrower and say, look, we want our money. So please, can you give us the cash? And that allows us to pay off the mortgage, but there's still a debt left over. In that case, the lender still has the legal ability to get that from the borrower. They probably won't get it. And there is a 6-year moratorium as well. If they've claimed on a mortgage indemnity policy, don't tend to do that anymore, then the mortgage indemnity insurance company also has the right of subrogation in order to get that money back from the borrower. So the poor old borrowers get hit twice as there's still a debt, isn't it? They're going to get hit by the lender and hit by the insurance company if they've paid a mortgage indemnity as well. Now, finish off then, there are some alternatives to this. Obviously, this is the repossession proceedings given to the Law of Property Act 1925. This is how we operate in the UK, Scotland, England, Wales is all the same, slightly different procedures, but it's pretty much the same. That's how we operate. There are other ways of getting the mortgage paid off, which is worth mentioning. 3 things to talk about. First of all, we could sue them on a covenant. Now, if I just pop these over here for you so you can have a look at these ideas. Let's just pop these in blue over here. You obviously got repossession. Number 2 is you could sue them on a personal covenant. Now, if you think about this, the mortgage deed, which the customer signed up to years ago probably, had a number of things they had to adhere to, covenants. And it might have been one of the covenants they didn't keep to. It could have been mortgage payments, could have been keeping the house up for repair. We could sue them on a personal covenant. I had a story once of a lady who had a property under mortgage with the company, Leeds, I think it was. But she was a pigeon lover. and she'd opened up her loft to pigeons, wild pigeons, nothing, not tame ones. So she opened up the loft, took all the tiles off, and all these wild pigeons in London would scoot in there, and they'd live there. You imagine the mess and the stink and the poo and everything. Of course, it was leaking into the property. The property was in complete disrepair. So we sued her under the personal covenant of not keeping the property in good repair. So very unusual. You could become a receiver. This is more for a buy-to-let property. Now, for example, if it's buy-to-let and there's a tenant, you could repossess the property, but keep the tenant in there because you can't kick him out, and keep receiving the rent. You would become a mortgagee as a receiver. You would be a receiver of the rent, and then the rent you then use to pay off the mortgage debt. So you could certainly do that if it's a buy-to-let property, just become the receiver of the money and pay that off the mortgage effectively if you wanted to do that as well. The last one is foreclosure. There you go, foreclosure. Now, we don't do that in this country. Not anymore, anyway. They do that in the US, by the way. You're probably aware of that. In the US, they don't have repossession proceedings. The bank just takes over the property. They become the owner. That's called foreclose, which is why when the housing market dies in the US, the banks become owners and they have fire sales of properties. Happened in the financial crash 2009-10. At the moment, the property market in the US is fairly stable, because people aren't moving, because they have fixed rates for 20, 30 years with the house, you see. So people aren't actually even moving, and therefore there's no supply. So property prices are still going up in the US at this stage. So that's the repossession proceedings. Now, as a young lad back in those days, back in 1986, I kind of just saw the whole thing in a blur, really. I hid behind the hedge, said to you, when the bailiffs went in there, and I was just representing. I went back, the guys at the branch said, what happened? I told them briefly, and I got on with my work. I didn't really know what was happening. So it makes you think about things, moved on so many more years in the future. Hope that's been useful. Bye. All righty. Okay. Hope you enjoyed that session there on repossession proceedings. Or pretty gloomy topic, really, isn't it, when it comes to it? Let's hope the numbers of repossessions are much, much lower in this coming recession than they ever would be, because to lose a house is a pretty awful thing, isn't it? Okay. Let's move over to our final topic then, capital gains tax. Just to summarise some of the figures, get things just ironed out for you. So we're going to head over to this whiteboard. So let me pop across to this whiteboard where I've already started here. My topic today is capital gains tax 2023-2024, because a couple of figures have changed. I thought I just want to make sure that you're comfortable with what's going on here. Now, the thing about capital gains tax is it is a personal tax. It's taxation on people, not on businesses, and we'll come on to that in a second. And the government, actually, according to the Office of Budget Responsibility, OBR, they're actually taking in about £18 billion in capital gains tax at the moment. So it's a kind of tax which the government quite like, because it earns them quite good money. And why not? If they're making good money, then they're probably going to keep it for a while. And it has actually been tweaked now, so they're going to earn some more. And I'll tell you how that works. First of all, capital gains tax, as we know, is payable on assets. And we often talk about a second property, don't we, as an asset. But you can have, paintings, sort of a nice little painting, like my Wayne right there, my property painting there as well. You can have jewellery, gold, silver, all those things. Obviously, shares, unit trusts. These are assets that people buy, and they keep hold of them, and then they sell them, and they made a profit. And it's the profit that's liable to capital gains tax, not the income. Remember that one as well. And that makes sense. Now, how can we reduce the tax? Because it's quite expensive now. It's payable at two different rates, basic rate and high rate. There's 10% for basic rate taxpayers at this stage and 20% for higher rate taxpayers. But if it's a second property, which a lot of our clients do, of course, buy-to-lets and things, they whack it up, and it's another 18%. So it's 18% there, or another 8%, I should say, and 28% for higher rate taxpayers. But that's all in the tax sheet anyway. You don't even need to know about that. So it's quite expensive, and what we need to do now is take a look at how we can possibly reduce anybody's capital gains tax bill. It's not our job as a mortgage advisor, but we need to be aware of these, particularly for the CMAP as well. First of all, you can take a look at some wrappers, as we call it. Let's give you some details here, some wrappers. So put your asset into a tax-free wrapper is the thing here. We mostly talk about ISAs. So buy your shares, unit trusts and things through an ISA. You could look at a SIP, which is a self-invested personal pension. So you can actually theoretically buy property in a SIP. Not a lot of people do, but you can. So that's a pension, of course, it's tax-free. The growth of a pension is tax-free. So that's the first thing to do, is think about your tax wrappers. You can do what's called a bed and ISA. So if you've got shares which are outside of an ISA, in other words, they will become liable to capital gains tax. You can do a bed and ISA. They used to call it bed and breakfasting, where essentially what you do is you sell your asset and buy it back 30 days later, but buy it back in an ISA. Okay, you've got a 30-day limit now, so things can go up and down, of course. You'd have to incur capital gains tax for when you've sold it, and fees, etc. But it might therefore be beneficial having that asset in an ISA wrapper. So that's the first thing to think about doing. Number two is to take your profits. So take your profits more regularly than you thought of. A lot of people keep things for years, don't they? The reason for that is everybody has an annual allowance. There you go, an annual allowance. Now, the annual allowance has gone down recently. This tax year, they've taken it down to £6,000. Next tax year, in 24-25, they're taking it down to £3,000. So they'll probably get rid of it after that as well. So this is per person. So if you have an asset and it's owned jointly, then you're going to get £6,000 allowance each. That means you're not going to pay capital gains tax on that amount of the gain. So that's worth doing as well, isn't it? For landlords, you could certainly put the property into an SPV, a special purpose vehicle. Now that, as you know, is a limited company. Now it's difficult to put an existing property in because you have to sell it and then rebuy it back with all that stamp duty and costs, etc. But if a landlord wants to buy a new property for her portfolio, she might well be better off buying it through a limited company, because companies don't pay capital gains tax, you see. So that's another way of getting rid of it as well. So that's something to think about. You could certainly use your losses, because losses can be offset against gains. So I've got here shares and jewelry and a piece of art there. Not a very good piece of art, that, isn't it? I don't think that's a constable, is it? Or a second property. Now, if you make a loss from selling an asset, you can offset that loss against any gain. That's pretty cool, isn't it? Years ago, a friend of mine bought some unit trusts during the dot-com crash in 2000, and he lost a lot of money when on those unit trusts. He didn't sell them, but the paper value had gone right down. And he bought a property as well, and he was about to sell that property. He had a big CGT bill to pay. So he talked about offsetting the losses from his unit trust. So he sold the unit trusts, declared his loss, used his allowance, etc. But that loss then he used to offset the gain on the property. So you can use losses until they're gone. You can use them year after year after year until they're gone as well. Number 5, think about your spouse transfer. Now, your legal spouse, if you were to transfer assets between spouses, there is no capital gains tax, because you just move from one to the other or put it into joint names or whatever. That way you can utilize not only each person's annual allowance, but you could also utilize maybe your spouse as a lower tax rate than you. Maybe you're a high rate and they're a basic rate, or even a no rate tax payer. So you think about that as well. That's something to think about, transferring between spouses as well. You could die. There we go. Not a lot of people appreciate that, and I wouldn't suggest that you do that, but you could die, because on death, the assets that you own form part of your estate, don't they? And then, of course, they get added up, and inheritance tax rears its ugly head. But you don't pay capital gains tax on the assets. They just value them at what they're worth. Obviously, the person who inherits your assets will have a capital gains tax bill starting from that particular point. So, for example, if there's a property, second property, and that gets inherited by your son or daughter, then they now own a property that's going to be liable to capital gains tax from that point onwards. So I'm not suggesting you die, but inheritance tax is 40%. It's a lot more than capital gains tax as well. And the last one as well is this is probably more to do with property than anything else. Is you can improve the property, so build an extension, for example. Any costs involved, and that goes for all assets really, any costs involved in buying and selling the asset, you can offset that against capital gains tax bill as well, as long as you've got records. And say any improvements to the property as well. I don't think you can improve a constable, can you? Maybe you can clean it, but that's maintenance. You see, maintenance is something you can't take off the profits from capital gains tax. So a lot of mortgage advisors get really hung up with capital gains tax, particularly for the exam. It's not that complicated now, actually, when it comes to it. You don't have to work out complicated examples. You have to be aware of the tax wrappers, for example. What assets are exempt from capital gains tax? That's a big one. Your prime residence, of course, is the main one. That's a second property. That's the big one. The government gilts, of course, are exempt because they can. Private cars are exempt as well. ISAs and pensions are also exempt. So you need to be aware of that, really. They're typically the questions you get in the exam. But that's useful. Of course, if your client needs further help, they have to go to their accountant. You're not qualified to give advice in that area. I hope that's been useful. Bye. All righty. Well done, everybody. Okay. Let's just wrap up then, shall we? Let's talk about what we got planned for you. We didn't have a live stream last Monday because it was a bank holiday, but we're right into September now, which is great. So moving forward, we've got a special offer actually on our boot camps this month. So if you bought a full boot camp, we post to you our revision guides. That's on us. So that's a pretty good offer to have. So you need to contact us for that offer. Get onto our website, which is archercourses.com. The sun's good. It's hot today and hot all week, so I hope you enjoyed the sunshine as well. As always, if you want to get onto our member database, there's the QR code. Just click on that and you can come onto our member list, and we'll keep you informed of all our special offers and what we're doing to help you become even better mortgage advisors and protection advisors as well. Other than that, I wish you the very best for your week ahead. Enjoy yourself, enjoy the sunshine, and we'll be back again next week to talk all things mortgages.